Hello, in this video, we are going to present about one of the financial instruments of the money market, which is Banker's Acceptance. What is Banker's Acceptance? A Banker's Acceptance is a short-term debt instrument guaranteed by a bank creditworthiness. It involves a bank agreeing to pay a specific amount on a future date for its customer, acting as the drawer. This guarantees payment to the holder, making it a low-risk investment. Banker's acceptance are frequently used in international trade and large transactions by various companies. In our presentation, we are going to explain about market players, reason of instrument issuance, benefits of investing, characteristic of instrument, and the maturity period of the banker's acceptance.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad HAKIMI, and today I would like to introduce you about Banker's Acceptance. Okay, first, Banker's Acceptance is a financial instrument that is issued by a bank and accepted by a bank's customs. There are several market players that participate and contribute to the functioning of the instrument. For example, this I will explain it to you in the next slide.
First, financial markets. Banks act as traders and matchmakers, buying and selling stocks, bonds, and currencies, keeping the markets humming. They advise companies on big financial decisions, like launching new businesses or going public, and help them raise capital. They manage investment portfolios for individuals and institutions, like a financial coach, aiming for the best returns. Second is retail banking, closer to home. Banks are where we deposit our salaries, take out loans, and use our debit cards. They facilitate secure and efficient money transfers between us. They offer financial products like mortgages, personal loans, and insurance. The third is worldwide connections. Banks bridge the gap between countries, financing international trade and ensuring smooth cross-border payments. They play a pivotal role in the foreign exchange market, determining global exchange rates and ensuring currency flows. There are different breeds in this investor. Retail investors is putting their hard-earned money into the market, hoping for a brighter future. The big cats is mutual funds, pooling resources from many individuals and hedge funds. Venture capitalists backing promising startups with their expertise and cash. Regulators is a team of officials from government agencies like SEC or financial conduct authorities to industry-specific bodies overseeing sectors like healthcare or energy. They represent the public interest, making sure businesses operate ethically and transparently, protecting consumers and investors from harm. Investment firms are like coaches for businesses. They find promising companies, like they invest money, they share their knowledge, they connect companies with others. And why are they important? They create jobs, support new ideas like.
The reason for issuing a banker's acceptance can be looked at from the perspective of both the buyer and the seller. Using banker's acceptance, the buyer hides from paying the full amount upfront and released on the bank's guarantee to payment at maturity. This reduces the seller defaulting in the transaction. Furthermore, banker's acceptance allows the buyer to defer the fees for the goods until the maturity date and give time for them to sell the goods. Also, produce revenue before settling the debt. Thus, their overall cash flow management becomes better. Besides, banker's acceptance offer a ready financial option backed by the bank's reputation when the buyer might have problems securing credit lines. Lastly, banker's acceptance can give the buyer purchase in negotiation with the seller, moreover, securing better terms on the hidden trade agreement. Banker's acceptance significantly reduces the risk of non-payment by the buyer when the bank becomes the most important obligor on the transaction, as well as that this is expensive when dealing with an unknown or unproven partner. Furthermore, guarantee payment will make the sellers believe in themselves of receiving payment at maturity. It is because the bank's reputation is on the line. This removes unsureness and potential delay connected with relying solely on the buyer's creditworthiness. At faster access to funds mean that the seller can discount the banker's acceptance in the secondary market and receive cash immediately if waiting time for payment at the end of the credit payment is longer. Hence, this can make their working capital and liquidity become better. Moreover, strengthen competitiveness because of banker's acceptance offering as a remittance option that can make the seller more competitive in the market, especially when dealing with risk-averse buyers.
For investors and companies engaged in international trade, a banker's acceptance (BA) is a financial instrument that offers substantial benefits. Banker's acceptance provide numerous benefits to both buyers and sellers, making them a preferred instrument in international trade and other financial institutions. Investing in banker's acceptance can offer several benefits, which include secure payment, trade facilitation, competitive yield, and diversification. First and foremost, secure payment. The seller issues a time draft and the buyer's bank guarantees payment by accepting the draft, thereby mitigating credit risk as the bank assumes the obligation to pay on the maturity date. This enhances transaction security, especially in cross-border scenarios with credit uncertainties, and is governed by legal frameworks to ensure compliance and reduce fraud risk. Next, trade facilitation. Facilitating international commerce transactions, it guarantees payment for exports, allows buyers to extend payment time, and enhances reliability and effectiveness in international processes. Purchase at a discount, it offers a competitive yield. A fixed interest rate ensures a steady yield at maturity, making it appealing to investors and standing out among short-term fixed income instruments for attractive returns. Furthermore, diversification. It reduces risk and improves stability in an investment portfolio while offering a dependable income source that integrates well with other asset classes. Additionally, it enhances flexibility in portfolio management and allows for taking advantage of market conditions.
Banker's acceptance is one of the most important concepts in the field of import and export. It enables two parties to have faith in one another regarding the source of goods and money received. However, in order for these financial tools to function, there are few characteristics that determine the banker's acceptance. For this, I will explain to you in the next slide. The first characteristic of banker's acceptance is high liquidity. Bankers' acceptance are highly liquid due to active trading on secondary markets, which allows investors to easily buy and sell with low transaction costs. This liquidity attracts investors who seek capitalizing on market changes. This instrument is also typically issued by reputable banks and widely accepted, which makes their reliability increase the liquidity. The second characteristic is short-term maturity. Bankers' acceptance have a short maturity, typically less than a year, making them suitable for short-term investments and as a source of short-term funding for companies. This short-term nature appealing to investors because it is considered a low-risk investment with a relatively high rate of return. They are commonly used in international business transactions because it is guaranteed by the issuing bank and distributed by commercial bank. The third characteristic is interest rate risk. Bankers' acceptance is exposed to interest rate risk as their yield is linked to broader market rates. Changes in interest rates can impact their returns, leading to lower yield with higher interest rate and vice versa. This risk may decrease the market value of existing bankers' acceptance, affecting investors who might experience a loss if sold before maturity. Despite the short-term maturity, price volatility remains a potential concern, which it can cause a fluctuation in market value for investors. The last characteristic is low credit risk. Bankers' acceptance are viewed as a low-risk investment due to the issuing bank's effective guarantee to pay the draft amount in the future. This assurance makes them a favorable choice for investors who are seeking a low-risk return. Most bank acceptance issued are guaranteed by reliable banks under central bank control, which it reduces the potential credit risk for investors. This is because central banks monitor and ensure compliance with rules and sufficient capital.
The maturity period of a banker's acceptance is the time between a bank accepting a draft and its due date. It is the period of time between the date on which a bank promises to make a future payment and the agreed upon amount. Usually, it is predetermined and agreed upon at the time of acceptance. Typically, the amount is determined based on the terms negotiated between the parties that are involved in the trade or financial transaction. Banker's acceptance gives the issuing company a way to make a purchase without having to take out a loan. The bill is a kind of payment that is guaranteed to the receiving company. Besides, the bank is required by a banker's acceptance to pay a holder a certain amount of money on a specified date. The maturity period of a banker's acceptance is often issued 90 days in advance, but it also can mature at any date between 1 to 180 days. Besides that, the maturity date can be approximately up to 3 months. The issuing company has the option to pay the bill before the maturity date. This early payment can benefit the issuing company because the company may receive a discount, which is often referred to as discounting. The accepting bank may earn money from the transaction and offers an incentive for early payment through the discounting mechanism. To conclude, bankers' acceptance are essential for short-term international trade and finance, providing a secure and low-risk financial instrument. They involve issuing and accepting banks, buyers, sellers, investors, and regulatory authorities. The benefits include secure payments, trade facilitation, competitive yield, and portfolio diversification. With high liquidity, short-term maturity, and low credit risk, bankers' acceptances are flexible and favored by exporters, importers, and investors for their safety and returns in the business world.